All right, hello everyone. This is David from Trader Dales, and today we're going to go over a recent swing trade that we did on Bitcoin, and I'm going to show you how we caught the recent move down, and just the overall basic logic behind it, which is pretty standard logic that we use in our trading, not only for swing trading but also for day trading as well. Okay, so Bitcoin's been in a major up move really since 2023. Okay. And, the way we understand order flow is price displacing, creating fair value gaps, which it does along the way. And we're on a monthly chart. We're looking more long term. So we have a fair value gap here that we tapped into, held it. Okay. And then eventually moved higher, taking out those previous highs, establishing a new fair value gap right here, bullish, where we tapped back into, defended, extended higher, taking out external highs. And this is basically how the market moves and how we determine order flow. Now, when that order flow changes, though, okay, it's typically when a fair value gap like this gets inversed. And once price closes below this inverse fair value gap, the order flow has now changed from bullish to bearish. Okay. And once we inverse this fair value gap, we created a bearish monthly fair value gap. Okay. While we did that, which is another bearish sign. This is one of our favorite trading setups in any time frame. An inverse fair value gap created with a fair value gap in the opposite direction. So the way we handle this is this monthly fair value gap. We don't automatically, short a move into that fair value gap. We need price to move into that fair value gap, and then we need to see on a shorter time frame how price is reacting. So if we go to the daily chart, we're going to want to see some type of accumulation, manipulation, and distribution. What we want to see is the short-term price action tap in and then go negative. How does it go negative? It creates an inverse fair value gap. So once it creates this inverse fair value gap to the downside, the short-term price action is now bearish, which aligns with the longer-term time frame. And in that position, like we did before on the daily, we created a fair value gap, which we use to tap into to enter a position to trade lower. Okay. Now, where are our targets here? Our targets are going to be external liquidity levels. The first external liquidity level was right here at 80,000, a little over 80,000. Okay. Main target was this external liquidity level right down here at 74,000. Okay. We had a lot of high volume right here that price tapped into. So anything below here was just kind of maybe a little bit of a runner, but we expected price to get some support around there. So therefore, we were only looking to take this from, and let's look at a daily time frame to make it a little easier. We were only looking to take this from the monthly fair value gap down into those liquidity lows, which were, let me put these on here. Okay, so if we go to the daily chart, we can see the setup easier. Tap into the monthly fair value gap. We're already bearish. We've already been confirmed that. Okay, now we just need to tap in to show us and the order flow on the short-term time frame, which is the daily in this case, to now invert a fair value gap, which now shows us that the short-term order flow is bearish, which is exactly what we want. And we're going to target the first external liquidity, which was the low that we made before the fair value gap, and then the next low in price right over here, okay, which was the main target for our trade. So if we're going to put a parameter on this, the short was going to be right here. Okay, target was that low right there. And typically on these, we put our stops right above that fair value gap to give it a little bit of room. Okay, so this was about a 7-to-1 risk to reward trade. Okay, all starting from a monthly view, a change in order flow, a bearish fair value gap created by that monthly, which is right here. And then on a daily chart, we use a daily time frame to indicate an accumulation, manipulation, distribution move that confirms that this monthly fair value gap is bearish, it's being defended, and that sellers are coming in to this gap to push it lower. That's our confirmation. And our entry model is this exactly. We inverse this fair value gap, we close below, we create another bearish fair value gap on a daily. We use that to tap into to execute our trade and then target these levels down here for a 7-to-1 risk to reward trade. Okay. We use this model on both our day trading and swing trading. This happens to be a swing trading example, but in day trading, it's very similar. We're just adding a couple of more confluence to it, obviously, because there are different levels that we need to take a look at, like previous day's highs and lows and data highs and lows and session liquidity. But when it comes to long-term swing trading or just swing trading in general, the higher time frame charts show us everything, and we can judge order flow by just seeing how price reacts to fair value gaps and external highs and lows through price discovery. Okay, and then we use the order flow on multiple time frames to construct a narrative of a trade that we can execute and target external lows in a proper direction or the proper draws on liquidity.
Hey everyone, it's Dale here. I hope you enjoyed the video. If you like to trade alongside me and our team of prop firm funded traders every day, then click the link below the video and hop aboard. We are looking forward to trading with you.